Welcome to This Explainer. If you've ever felt like you're just always one step behind the market, believe me, you are not alone. Today, we're going to shift your mindset from reactive to strategic. We're pulling back the curtain to expose the hidden engines that actually drive global wealth. Let's kick things off with a pretty crucial question. Look, the financial news is constantly selling us this narrative of chaos, right? They make it seem like the market is just this wild, totally unpredictable roller coaster. But is that actually true? Or are we maybe just looking at a highly structured system without having the underlying blueprint? Honestly, the single most powerful advantage you can build over a lifetime of investing is finally realizing that these systems, they aren't random at all. They run on predictable engines. It's this fascinating, interconnected web of economic fundamentals, monetary policy, and of course, investor psychology. And I promise you, once you actually recognize the pattern, you literally can never unsee it. So here is our roadmap for today. First, we'll look at the hidden market cycles, then compare stocks versus real estate, and dive into the engine of asset prices. After that, we'll cover global shocks and migration, institutional versus retail investors, and finally, wrap up with how you can actually build sustainable wealth. All right, let's jump right into part one, the hidden market cycles. Real estate actually moves through four very distinct phases. It all starts with recovery. Vacancy is high, sentiment is pretty bleak. And that is exactly when smart institutional capital quietly slips in. Next up is expansion, where rents start rising and credit loosens up a bit. Then we hit hypersupply. Construction peaks, speculation is running wild, and this is usually when retail investors come rushing in, totally driven by FOMO. But sadly, they're way too late. Finally, recession hits, prices correct, and the whole cycle just gets ready to reset. But here's the crucial thing you've got to remember. Real estate is local way before it becomes global. For instance, a market like Dubai might be in full-blown expansion, right while some major European capital is going through a really harsh correction. Meanwhile, Southeast Asia might be sitting on some sweet early recovery opportunities, while North America is practically drowning in hypersupply. Seeing this geographic divergence, it creates absolutely massive opportunities for you to rotate your capital instead of just sitting trapped in your one single domestic market. Moving on to part two. Stocks versus real estate. Because of instant liquidity, we're talking financial assets being traded in literal milliseconds, equity market cycles complete their full arc incredibly fast. A complete cycle takes just 3 to 5 years, with these little microcycles playing out in a matter of months. Now, in stark contrast, real estate cycles are incredibly slow. They can take anywhere from 7 to 18 years to complete the whole shebang. It makes sense, right? You just can't trade houses in seconds. So because of this massive speed gap, the stock market actually acts as your early warning system. Think about it. When banking and construction stocks are showing sustained strength, a real estate recovery is usually brewing right behind it. On the flip side, if financials start underperforming and bond yields invert, well, property markets are usually about 6 to 18 months behind. Stocks are, quite literally, your crystal ball.
Okay, let's get into part three, the engine of asset prices.
Interest rates act kind of like gravity on asset prices. Just by tweaking the cost of borrowing, central banks can essentially revalue every single asset in the economy. Take a look at recent history. In 2022, we saw the most aggressive rate hikes in 4 decades, which quickly compressed corporate profit margins. And by 2024, that gravitational pull caused simultaneous corrections across global real estate and equity markets, as all that capital suddenly rotated defensively. And then, of course, we have inflation. But for us as investors, the absolutely critical distinction here is where that inflation is actually coming from. See, demand pull inflation reflects genuine economic growth, and it actually protects your assets by pushing up rents and property values. But cost push inflation, the kind driven by supply shocks, that is a massive wealth destroyer. It spikes operating costs and simultaneously forces those super aggressive rate hikes we just talked about, effectively crushing leveraged investments. That brings us to Section 4, Global Shocks and Migration. Beyond the pure economic models, real-world events act as these huge, unseen structural accelerators. Geopolitical shocks, sustained migration. They basically put a permanent floor under real estate prices in key global hubs. When places like London, Singapore, Dubai, Sydney, or the American Sunbelt experience massive inward migration, well, demand suddenly becomes structural, not just cyclical. And that essentially shields those markets during downturns and absolutely supercharges them during recoveries. Moving right along to part 5, institutional versus retail investors. This right here is probably the most exploitable dynamic in the entire market. It's wild. Retail investors consistently buy at the peak and panic sell at the absolute bottom, while institutions do the exact opposite. Institutions have the long-term mandate and the patience to just quietly accumulate during market bloodbaths. Meanwhile, retail investors get completely hooked on media narratives and FOMO, jumping in right as prices peak. Honestly, it's not a gap in intelligence at all. It's entirely a gap in time horizon and emotional discipline. And finally, let's look at part 6, how to build sustainable wealth. The investors who built true generational wealth during historic periods of distress, like the post-2008 financial crisis or the March 2020 pandemic crash, they weren't psychics, you guys. They just had the liquidity to act when the media narrative was absolutely terrifying. They scooped up assets at steep discounts simply because they have the capital ready to go and the framework to actually deploy it. So if you want to invest like an institution, you really have to stop looking at cash as a missed opportunity and start treating it as strategic optionality for the next cycle. You need meaningful liquid reserves so you can strike during recoveries. You need geographic diversification across different cycle phases so you don't get trapped locally. And crucially, you must prioritize genuine income generation, things like strong rental or dividend yields, instead of just crossing your fingers and hoping for capital appreciation. I really want you to take away one incredibly powerful realization from all of this. The difference between investors who build sustainable wealth and those who don't is rarely about analytical intelligence. It is almost always about emotional discipline. Literally anyone can memorize the data, but having the stomach to hold steady, to buy during all the bad news, and to sell when everyone else is getting greedy, that right there, that is the actual secret. So we've popped open the hood and shown you the hidden mechanics of the market. But the biggest, most important question is how you will choose to drive. Because the next cycle, it's already turning. Will you be out there just reacting to tomorrow's sensational headlines? Or will you be waiting patiently with strategic capital? Think about it and start building your framework today.